5 key pension news items. Like this video and subscribe to the channel to stay informed about the latest pension news. Let's start with the 5th news item. Pension credit increase in 2024. Over 1.4 million Brits to benefit. Here's the expected raise. In April 2024, recipients of pension credit can expect a significant increase of 6.7% in their payments. This boost, in line with the Consumer Price Index (CPI) inflation for September, will positively impact the lives of 1.4 million British citizens who rely on this financial support. Pension credit, a program provided by the Department for Work and Pensions (DWP), is designed to assist elderly individuals in the UK who have low incomes. Not only does this benefit offer crucial financial aid, but it also opens doors to other forms of support. Supporting benefits. Alongside the primary benefits of pension credit, recipients may also become eligible for a range of additional advantages. For instance, those entitled to the main part of pension credit could receive reductions on their council tax bill and access the warm home discount, cold weather payments, housing benefit, free dental treatment, and vouchers for glasses or contact lenses. Furthermore, individuals aged 75 or older receiving pension credit might be eligible for a free TV license. It is estimated that on average, pension credit recipients are £3,900 better off annually, as per calculations from the DWP. However, around 880,000 eligible households may not be aware of or receiving these payments. Increase in pension credit. There are two components to pension credit: the standard minimum guarantee and the savings credit. For single individuals, the standard minimum guarantee is projected to rise from £201.05 per week to £218.15 per week, while for couples, it will increase from £306.85 per week to £332.95 per week. To qualify for this part of pension credit, individuals need to have an income below these thresholds. However, there may be exceptions for those with a higher income but facing additional circumstances, such as severe disabilities, caregiving responsibilities, or housing costs like mortgages. Savings credit. Individuals eligible for the savings credit element of pension credit, specifically those who reached state pension age before April 6, 2016, may also expect an increase in their payments. For single people, the savings credit will rise from £15.94 per week to £17.01 per week, and for couples, it will increase from £17.84 per week to £19.04 per week. Those with savings or a second pension may also qualify for this part of pension credit. Extra support. Additional payments may be available for individuals fulfilling criteria such as being a carer, having severe disabilities, or being responsible for a child or young person. Moreover, pension credit can be backdated for up to 3 months, enabling retroactive payments for those who were eligible during that period but had not yet started receiving the benefit. Application process. Applicants can conveniently apply for pension credit via 3 channels: online through the Gov UK website by calling 0800 99 1234 or by filling out a printed application form. Individuals must be over the state pension age of 66 and reside in England, Scotland, or Wales to be eligible for pension credit. By adhering to the rules of storytelling, the news has been rewritten to provide a clear and engaging narrative, capturing the essential information while maintaining a logical and structured flow. Exploring the best pension options in the UK, a guide to starting your retirement savings. As you embark on your professional journey, retirement may appear distant. However, the significance of saving for a pension cannot be overstated. Time has a way of passing quickly, and it is crucial to begin early to ensure a secure future. Today in the UK, retirees receive a modest weekly state pension of £203.85, provided they have dedicated 35 years to national insurance contributions. While the current state pension age is 66, it is scheduled to rise to 67. The Department for Work and Pensions reported that in 2022, the average weekly income for pensioners rested at £349. However, if your aim is to enjoy a reasonably comfortable retirement, it is evident that a more substantial nest egg would be required. Experts suggest allocating approximately 15% of your annual pre-tax income to to pension savings for individuals starting in their 20s. An alternate approach advises halving your age when determining the amount to set aside. Realism, however, sits at the core of this decision, as it demands a long-term commitment to reap handsome returns. Before determining your investment amount, it is vital to consider various daily living expenses, such as mortgages or rent, utility and food bills, as well as allowing for one-off expenses like vacations, home improvements, or indulgences that enrich life. If you are a full-time employee, take advantage of your company's pension scheme, which often matches your contribution up to a certain percentage. This popular option eliminates the need for extensive investment knowledge as the company collaborates with a pension provider to handle investment decisions. However, once invested, your pension funds remain inaccessible until you reach the age of 55. Self-employed individuals are encouraged to explore self-invested personal pensions, SIPs. Although lacking employer contributions, your own contributions are tax deductible. Additionally, by managing your investments independently, you can avoid the costs of professional advisory services. Online comparison sites can assist you in finding a financially stable provider that aligns with your needs. Consider the Lifetime ISA if you are under the age of 40. This particular retirement savings option allows annual contributions of up to £4,000, with the government contributing a 25% bonus to your savings. However, it is important to note that early withdrawal entails a 25% penalty. Helen Morrissey, head of retirement analysis at Hargreaves Lansdown, emphasizes the importance of saving within your means. Utilize online calculators to model your projected pension growth, enabling informed decisions regarding your contributions. Referring to retirement income standards issued by the Pensions and Lifetime Savings Association can serve as a helpful guideline towards achieving a moderate, basic, or comfortable retirement. The role of pensions in Europe's ongoing capital markets evolution. As Europe approaches the 10th anniversary of Jean-Claude Juncker's vision for a European Capital Markets Union, CMU, the unfinished project remains crucial for the continent's financial integration. The CMU aims to streamline cross-border capital flow, reduce funding costs for small and medium-sized businesses, and enhance Europe's appeal to investors. Christine Lagarde, president of the European Central Bank, emphasizes the need for completing the CMU, highlighting the importance of technical reforms and addressing issues related to an aging society and the shift towards renewable energy. Furthermore, Europe must counter the gravitational pull of the U.S.'s robust stock markets, which often lure innovative companies away. The complex challenge of immigration. While populist politicians may use migration as a campaign focal point, it is essential to present immigration as a complex challenge with both benefits and solutions. Restricting highly skilled individuals from contributing to Europe's economic growth is counterproductive, while immigrants can fill crucial positions in healthcare, social care, and agriculture. Germany's experience with immigration since 2015 has disproven initial fears, with economic research indicating that skilled immigration plays a vital role in the country's success. Immigrants contribute to the state through taxation and positively impact pay-as-you-go pension finances. Unlocking the power of pensions. To promote financial security for all, it is imperative to provide access to tax-advantaged workplace pension schemes. The capital accumulated through these schemes can be channeled into productive investments, such as European venture capital or private long-term investments. However, existing initiatives like the Pan-European Personal Pension, HEP, have fallen short, highlighting the need for more innovative and impactful solutions. Policymakers should consider introducing IORP3, which could turbocharge the development of a high-quality workplace pensions policy. Additionally, exploring initiatives like a dedicated green paper for supplementary pensions and long-term savings can foster greater engagement. Diversifying funding sources. As Europe moves towards safer banks under Basel III reforms, the need to diversify funding sources becomes crucial. While banks remain traditional providers of growth capital, they face constraints due to balance sheet limitations. To address this, non-bank funding options must be boosted, with pension funds being a potential solution. Many pension funds already engage in private market strategies, such as direct lending, and their participation in securitization could further enhance the risk-reward dynamics. By freeing up banks' balance sheets, securitization enables them to continue their core role while allowing pension funds to earn a risk premium. The unyielding importance of the CMU. Although it may not take center stage in the upcoming European Parliament elections, the CMU should not be overlooked by the next Commission. Recognizing that pension funds play an integral role in implementing the CMU is vital for securing Europe's future prosperity. Additionally, addressing the concentration of household savings in low-risk holdings, exploring investment products, and reviewing initiatives like the European Long-Term Investment Fund can further bolster Europe's financial landscape. Europe's strive towards an integrated and dynamic capital market faces numerous challenges, including the completion of the CMU and the complexities of immigration. Through the implementation of effective pension schemes and diversifying funding sources, Europe can unlock its true potential and attract investment. As the continent confronts the gravitational pull of American markets, the CMU must remain a priority for the next Commission to ensure Europe's future prosperity. Relief for UK households. Free £50 supermarket voucher initiative to ease cost of living challenges. In an effort to alleviate the burden of the ongoing cost of living crisis, the UK government has announced that households across the country will be receiving a much-needed boost. As part of an extension to the Household Support Fund, the Department for Work and Pensions, DWP, has allocated an additional £842 million to assist the most vulnerable individuals and families in England. To ensure that this financial aid reaches those who need it the most, this funding will be channeled through local councils. In the town of Southend, for instance, households are set to benefit from a generous £50 supermarket voucher aimed at providing immediate relief to combat rising food costs. The Household Support Fund has been designed to offer assistance to low-income households, spanning across various vulnerable groups, such as families, pensioners, unpaid carers, care leavers, and disabled individuals. It aims to address pressing needs by providing support in areas such as energy, food, and hygiene products. Southend Council, taking the initiative further, plans to distribute supermarket vouchers to households with children who receive free school meals. In light of the increasing financial hardship faced by many residents, particularly those in lower income brackets, this additional allocation of funds is greatly welcomed. Councillor John Lamb, Cabinet Member for Regulatory Services, emphasized the significance of this endeavor, stating, "Unlike some other forms of funding, the HSF funding focuses on immediate assistance for essential items and targets those who may not qualify for other government support. If you are facing hardship and could benefit from this fund, please reach out to the Council's Essential Living Fund team." It is important to note that eligibility for this aid will be determined automatically, negating the need for households to apply. Notifications will be sent out by their children's schools, ensuring that assistance reaches those who require it. Each eligible child will receive a £50 voucher, enabling families with multiple children to benefit from multiple vouchers. This initiative has previously been put into action, with struggling families in Southend receiving similar vouchers in June of last year, and will now be extended to January 2024. UK's economic forecast. Experts predict grey gloom until polling day, amidst uncertain times. According to a recent survey conducted by the Financial Times, economists predict that the UK economy will remain in a state of grey gloom until the upcoming general election. While inflation is expected to decrease, leading to higher wages for UK voters, the cost of living crisis will continue to pose challenges, particularly in relation to mortgages and rent. The survey, which includes responses from 90 economists, reveals that living standards are unlikely to see significant improvements before the election, despite some sectors experiencing recovery. Low-wage workers will benefit from a rise in the minimum wage, and pensioners will continue to enjoy favorable savings rates. However, renters and households renewing mortgages will face elevated costs. The survey indicates that economic growth is expected to stagnate or be minimal in 2024, and while inflation is projected to decline, it may still impact living standards until a sustained improvement in disposable income is achieved. Economists suggest that higher public investment is crucial to the UK's long-term growth prospects. The survey also highlights the need for planning reforms and increased public investment as key policy changes following the election.